One quote in the story, which just kind of encapsulates everything, is that the German bond market is incalculably volatile. Yet they're still trying to come up with a way to calculate
Exactly.
it.
Well, I mean, what do you do if you hold all of this debt that's pegged to German debt? I mean, German bonds, let's put some perspective on this, are basically Europe's version of the U.S. Treasury market. They're what, debt's benchmarked to. They sort of set the tone for borrowing costs for companies, for people looking for mortgages, et cetera. So, if you have extreme volatility in this market, it creates the potential for ripple effects through all other markets in the area, which is a problem. So how do you calculate it? Do you just throw up your hands and say, oh, well, let's just throw a dart at a board, right? You kind of can't do that if your job is to manage money, professionally. So what firms like BlackRock are doing is they are changing their models to account for greater volatilities, particularly in the longer dated debt, as well as new correlations, such as, the German Bund and the Treasury yields and the euro and how these all, sort of play together. Because increasingly, with central bank dominance, you are seeing some correlations that, during stress times in particular, really tick up.
What does this tell you about the validity of these models in the past if they're so willing to now ditch them just because they don't like the results?
Good question.
My father's a mathematician, and when I started covering bonds, I remember he said to me, models are fantastic, except that if you get the wrong parameters, they're useless, And so you have to kind of adjust models depending on your time. And then you also have to have people who kind of question those models and think about, well, so let's take a big picture. Let's think logically about what some of the scenarios are. I mean, no model is going to be absolutely perfect through absolutely every financial cycle out there. The idea is just to measure some way of how hedged are we in the case of something that is unexpected.
Very quickly here, liquidity concerns have dogged the bond market. Did the ECB add liquidity or take away liquidity with its QE?
Well, liquidity is a tricky word, but I think that, they definitely suppressed borrowing costs. But when you get such low borrowing costs and you have people all flooding into the same instruments, it gets tricky to have a true two-way market, which is typically what people think of when they think of a liquid market.
So it becomes a crowded trade where everyone's
lots of crowded trades.